Welcome everyone for another presentation on JobKeeper provisions. I'm Alexis Kokkinos, a tax partner of the Tax Consulting Division. Today we are doing our fourth presentation on JobKeeper, and today's presentation is looking at some specific rules that have come out with respect to applying the JobKeeper provisions to employment entities or entities that provide employees to other members of a group. These rules just came out on the weekend. They came out Friday night and on Saturday. So they are very new. I will highlight that although they have come out on the weekend, the provisions didn't come out with a lot of guidance and a lot of other supporting documentation. So there are a number of issues again that I'll be going through today that are unclear and uncertain. We will be trying our best to provide as much information during this session to help you work through your employment entities and understand how the JobKeeper provisions work for you. We will be seeking some clarity from the ATO on a number of the items we're raising today. And the ATO's final view may differ to some of the conclusions that we provide today as well. So things may move over time. So the key message I want to say at the start is that the information contained in this presentation may change, may not represent ATO views, and you should always be seeking appropriate advice with respect to your calculations and continue to check the ATO for their updated views, as this session will be a very complex session and could be subject to very complex calculations. So I'll just highlight that up front because it's very, very important. So just before I jump into the special rules that have been created for employment entities, it's probably worthwhile just recapping for 5 seconds in respect of what the JobKeeper provisions require and what they do. So we're all hopefully aware of JobKeeper being a subsidy program that is providing a subsidy for each employee of an eligible employer that meets a requisite decline in turnover, and the subsidy is $1,500 per fortnight for each employee. Now, the basic tests for employers require you to look at your projected turnover, so that's really the turnover in the test periods where the fortnight falls in. So the first test period was 12th of April, it covered the periods of March, it covered the period of April, and it covered the June quarter. So you looked at your GST turnover or projected turnover for those periods, and you compared it to the current GST turnover, which was the GST turnover of the same period in the prior 12 months, so in 2019. And there needed to be a decrease or a shortfall of at least a specified percentage, which for most entities with $1 billion or less was a 30% decline. You need to show that your turnover had declined by 30% from 1 year to the next for the test period that you're looking at to get into the JobKeeper provisions. The ATO, as we went through in our third series presentation, came up with 7 alternative tests where you don't meet that test, and they are listed on this slide. So they cover scenarios where there could have been transactions or other events that have happened in the last 12 months that would have made it difficult for you to pass the 30% decline test. The entities could otherwise apply one of the 7 or more tests to determine whether they had a appropriate decline. So we covered that in session 3. Now that is important because we will come back into the calculations we're talking about today again. So then a number of groups operate in a structure where they have an operating company that serves the outside world, and then they employ all the staff in an employment entity. So in this basic example, we have a holding company, BizCo, it owns all the shares in operating company, it owns all the shares in staff company. And StaffCo has all the employees and just charges a service fee to the operating company. And the service fee is based on cost plus a small margin, just say it's 2% margin. Now, operating company, it doesn't have any employees, might have some directors, and it has suffered a 30% or more decline due to COVID. But when it went to apply the rules, because it didn't have any employees, it couldn't get access to the JobKeeper provisions. If you looked at StaffCo, on the other hand, it had no decline in turnover because it was just simply charging cost plus. It hadn't reduced any staff members, and so therefore its turnover had remained the same. And when it applied the JobKeeper provisions, it wasn't currently meeting the decline in turnover test. So this was represented as a problem with the Treasury. This was shown from day one, this type of example, and it has taken a little while for them to develop special rules that are trying to deal with a scenario where you couldn't effectively test the appropriate entities when you ran this type of structure, which is a very common structure. So on the weekend, what we received was the Treasurer issued an amending legislative instrument. So it amended the original rules. It's contained in the Coronavirus Economic Response Package Payment and Benefits Amendment Rules number 2, 2020. That's the name of the amendment, and it amends the original rules. It provides a new modified test for employment entities specifically. It's Section 8, capital A. And they're able to test the decline in turnover under this new rule based on looking at the turnover of basically the operating entities or the other entities that are outward facing in the group. So the ones that have sales to third parties can be included in this grouping rule. Now we're going to go through this grouping rule in quite a bit of detail during this session. Hopefully we'll give you enough information to start you on these calculations. So you should be able to hopefully work through a turnover test under the new modified test under Section 8, capital A. Now, before we start, I think it's really important that we need to talk through some of the basic tests that you need to satisfy for your employment entity, because not all employment entities will be in the rules. Now, the critical thing here is that an employment entity, when it's applying the JobKeeper provisions, the decline in turnover test is just but one test of all the tests, and there are qualification requirements. One of the critical conditions is that the employment entity must carry on a business in Australia on 1 March 2020. That is absolutely critical. You can't get around that test. So if your employment entity has never charged its costs to the other entities, for example, you're in a consolidated group and you haven't been charging your cost to the other entities, you may not be in these provisions. If you've never made a profit on charging those costs, so never marked it up, never made a profit, never had a prospect of profit in the entity, you may not be in these provisions. To carry on a business, the ATO take a view that the entity would need to make a profit or would have a prospect of making a profit, as contained in a number of their rulings. So you would run a risk, if you haven't been doing those things, that you may not be carrying on a business in the employment entity. That is a critical thing to be looking at. A number of employment entities may not have a legal agreement between them and the entities they service. Now that may come down to the ATO looking at that and saying there's no commercial arrangement between that entity and the other entities. It may also question, therefore, if you're carrying on a business again with respect to that entity. That is, if you're carrying on a business, they may expect there to be commercial arrangements in place as you would with third parties. So again, if you don't have any of these two items, i.e. profit or legal agreement, you may need to examine whether you really do believe that employment entity will meet the first basic condition to be in the JobKeeper provisions before moving on. I think that is absolutely critical before doing the additional work. So assuming that we get through the basic conditions, what the new rules have provided is a new modified test if you can meet 5 basic conditions for the employment entity. The first condition, and these are all listed on the slide, the first condition is the employment entity needs to satisfy a grouping test. So it needs to be a member of a consolidated group, a consolidatable group, or a GST group. The second test is it needs to satisfy a principal activity test. So it needs to have a principal activity of supplying other group members with employee labour services. Now we will go through each of these tests in detail and explain exactly what they mean and what hopefully should be required to satisfy those tests. The third test is that the group needs to satisfy an external supply test. So they will look at one or more members of the group, and those members need to have principal activities of making supplies to non-group members, so external parties. And essentially what it's trying to do there is look at whether they can test other entities in the group and whether they are making sales to third parties and whether they have effectively had a decline. The fourth test is a merely incidental test rule. And what it says is that you can't provide employee labour services to members out of the group other than them being merely incidental to their principal activity. And we'll cover what that means by merely incidental, i.e. if you provide 2% of your services outside the group, can you get through that rule? Finally, there's an additional integrity rule over and above the ordinary integrity rule, where the commissioner can disallow the entity from using the test if he writes to that entity and tells them that he doesn't believe it appropriate. Now, there are some conditions on him making that determination, but he can turn around and tell an entity that they are ineligible to apply this rule. And we'll go through that in a little bit of detail as well. If you get through those conditions and you can apply this test to the employment entity, what it does is it modifies the ordinary basic decline in turnover test. So remember, the ordinary test, it looks at your projected turnover for the period, so the 2020 turnover. So just say we're looking at April, and you compare that to April 2019, which is the current GST turnover. The employment entity would disregard their own turnover. That's the first step. They would disregard that, and instead they would use the projected turnover and the current GST turnover of each test member. And we'll go through what a test member is, but you replace it with those test members. So effectively looking at a group turnover, but excluding the employment entity. Now, the rules also allow the test members to use the alternative test. So those 7 alternative tests, they can also choose to use one of those alternative tests if the basic test may not otherwise apply to them, or if it's not appropriate. So there is an opportunity there to use the alternative tests, which means that they may get access to 7 tests in terms of each one of those test members. So as you can assume or imagine, the calculations can get quite complex when we start incorporating all of the alternative tests. As an example, and returning back to that first example that we spoke about, again, we had a BizCo that owned OpCo and StaffCo, and in the example, they would all be in what we would call a consolidatable, tax consolidatable group if they were 100% owned. So they would potentially satisfy the qualification of being in a group. And assuming that StaffCo had charged services to Operating Co, and Operating Co principally provided its activities to third parties, it may be in the rules again. If we satisfy all of these conditions that we will cover in detail, if they satisfy those 5 conditions, then essentially what can happen is the turnover of OpCo is used as the modified test for StaffCo. So given, as per the slide says, that the operating company has had a more than 30% decline in turnover, that would be attributed back to StaffCo under the modification test, and StaffCo therefore will pass the basic decline in turnover test under section 8A. So in a very basic scenario, that is how the rules are intended to apply. But obviously the normal case for most groups are more complex than this. And so we'll go through each of those 5 steps and explain how they apply and how it may apply in your scenarios. Okay, so the first test is the group test. So as mentioned previously, there are 2 types of groups that you can be for the purpose of this test. You can either be a consolidated group or consolidatable group, and that's on the left-hand side, or you may be a GST group, which is represented by an example on the right side. So what are those types of groups? Well, a consolidated group or a consolidatable group is usually pretty easy to identify, and there shouldn't be many problems in trying to identify that group. It generally consists of Australian resident companies that are wholly owned in a group. So as you can see on the left side there, you have Employment Co owning 100% of BizCo. It would be a wholly owned group in that circumstance. It is either already consolidated or can be consolidated. If it can be consolidated, it will meet the definition of being a consolidatable group, and therefore it's capable of being a group for the purposes of the employment modified test for JobKeeper. So I think the ones on the left side, the consolidated group, 100% owned corporate groups, are generally going to be the easy ones to identify. The second type of group is the GST group, and this is a little bit different and doesn't include potential GST groups. It is a group that has elected to be a GST group. So very different. Remember, the consolidated groups could be ones that haven't formed. In the GST group scenario, it will be ones that have actually formed a GST group. Now, the additional thing with GST groups is that it's not a one in all in as it would be for tax consolidation. You can elect members to be part of the GST group, so you might not have everyone in the group. Generally speaking, also GST groups can be formed where the group is a 90% owned group rather than a 100% owned group. So corporate groups may be GST groups if they have 90% ownership in the relevant entities. The critical part here, though, is that many GST groups have additional entities, including trusts and partnerships. Now, many groups have formed a GST group, including trusts and partnerships, but however, many of those groups don't potentially meet the technical requirements under Division 48 and regulations relating to Division 48, where those trusts and partnerships are involved. Now, generally speaking, there were supposed to be amendments to the grouping rules back in around 2010, 2011, and they never eventuated, which would have made life a lot easier around trusts and partnerships. The ATO generally haven't applied any compliance resources in challenging groups that have elected to include trusts and partnerships in the group. And that's mainly, I would believe, that it's usually an in and out for GST purposes, so there may not be much in terms of GST collection around that issue in terms of ATO unwinding GST groups. However, this is a precondition for this employment test. You need to be either a consolidated group or a GST group to get into these rules. And if it's a precondition, it will require technical satisfaction of that condition. So if you do have a GST group and they technically don't meet the requirements to be a GST group, you would have a significant risk that you cannot apply this test and that these rules are not applicable to you. So even though you have a registered group, you may find that the ATO could challenge that if your GST group is not technically one that meets the requirements. And I'm going to demonstrate that in a few examples to show where it may be an issue. So in this first example, we have a trust, which is not in the group, and it owns 100% of two companies that sit side by side. And assume that they've elected to form a GST group in this scenario, and they've carried on as GST group for a number of years. Now, in this example, the two entities aren't a part of a 90% owned corporate group, and given the trust is outside of the group, this is unlikely to satisfy the requirements to form a GST group. So this is one where a group may have carried on as a GST group and the ATO could challenge it if they were seeking to use JobKeeper provisions and claim that they meet the first criteria of grouping. Another example here is we've got three trusts, a service trust, a development trust, and a land trust. Got no corporate entities in this group. And then we have a trust above that, which is basically the investment trust, where we have distributions going to that trust. Investment trust isn't carrying on to say an enterprise, it's just simply receiving trust distributions, hasn't elected to be part of a GST group, it's outside of the group. Now, in this example, I'm not going to go through this in a lot of detail, but the fact that the service trust is distributing some profits to the trust outside that group, that potential GST group, and we're saying the GST group potentially here is the three trusts in the green. Because it's distributing 50% outside of the group, which may or may not go to the individual beneficiaries, there may be a technical issue with applying what we call an interposed entity rule when doing grouping. Now, again, the ATO may not have challenged this group previously, but there may be a real question as to whether the service trust actually is part of a GST group due to its historical distributions that it has made, and whether it technically meets the requirements of Regulation 4810.03 in respect of distributions that it has made and the interposed entity rule on distributions. Again, I'm not proposing to go through those in any detail, just highlighting a risk that GST group may not exist if certain conditions aren't otherwise satisfied. This third example, I think, is very, very relevant because it covers a professional practice, and the general structure for a professional practice may require a partnership between individuals, which is shown on the left side, and it may have a service entity that employs the employees on the right side, and the professional partners in that practice may have their interest in the trust, which may be a discretionary trust. It may have distributions or an interest via a corporate beneficiary that also receives distributions from a discretionary trust. So in the example on the right side, you have the service trust distributing to discretionary trusts of each of the partners that are distributing to a corporate beneficiary. And the question would be, could they form a group? Now, again, without getting too technical, Regulation 48.10.03 does look at the trust and does look at whether there are associated persons being permitted beneficiaries that are associated with that partnership, and does look at individuals with respect to that, that test. Given the distributions are going to other trusts and are getting accumulated in a corporate, there may be, again, a technical risk that you don't trace through to those individuals, and you may not meet the qualification to group that trust. So it can be quite common to have these in a GST group. Again, I highlight the risk that technically it may not meet the requirements of Regulation 48.10.03. So it is absolutely something that needs to be checked prior to applying these rules. So just some additional questions on grouping. So the first one there is, when do you need to satisfy the grouping test? So when you look at the provision, it's not absolutely clear as to when you need to be grouped, but the way Section 8A links back in is it links back to Section 6, which says that you need to satisfy the requirements at the end of a JobKeeper fortnight. So if you're trying to get JobKeeper payments back to 12th of April, it would need to be a part of a group at the 12th of April. That would be, we believe, to be the right timing. So what happens if you form a GST group as of today? It probably means that you could potentially qualify as a group as of today, but you may miss out on a number of payments, being the first two fortnight payments for JobKeeper provisions, because you wouldn't be a group for those two first fortnights. So then, can you retrospectively form a GST group? Yes, you may be able to retrospectively apply to form a GST group, and that may get you through the conditions so that you were a GST group as of 12th of April. Now, we do highlight that the HO have taken a view with respect to retrospective ABN applications, where they're saying if you're making a retrospective ABN application pre-1 March to get through the ABN requirements, that they may not technically allow that, i.e. you weren't actually technically registered at 1 March. So I just highlight that the HO may take a view that retrospective applications are not effective for the purpose of this test, and we should wait to see what the HO says on that if you are trying to rely on that. Can the integrity rule apply if you form a group? So Section 19 says if you do anything that effectively gives you access to JobKeeper payments, they can deny that under Section 19. The question that would come up here is whether just making a tax election would be something that would fall into the integrity rules. Hopefully HL will say just making an election wouldn't be something that is covered by it. Hopefully they only say that if you put yourself in a position to make an election, that would be something only they would consider. That being said, it is a risk, and so if you are doing that, you would need to probably take care, and you might need to get some advice around as to whether the HO would look to apply Section 19, as Section 19 means that you get no entitlement to JobKeeper payments if they apply that provision. Lastly, if you're two or more, if you're a member of two or more groups, how does this rule apply? Essentially, you get to choose that group that you apply to. You cannot apply to two groups, you need to select one of them. And it's probably demonstrated on this next example where I've got two potential groups that the employer companies are part of. It's a part of a consolidated group consisting of Holdco, Empco, and Bizco. And it's also part of a GST group, assuming it's consisting of Empco, Bizco, and the discretionary trust A in this scenario. So you get to select which one of the two groups you can apply it to. Now, one of the key things that you need to be mindful of, though, when we get to test 4, it needs to provide employer services only to members of the group. So if you selected the consolidated group and you provided services to the discretionary trust A, you would probably not satisfy test 4 later on when we get to it. Or if you chose the GST group and you provided services to Holdco, then you potentially may also fall out of the rule. So you need to be very, very careful when you look at selecting a group. You need to select the group that you're providing services to. You shouldn't be selecting just any of those two groups, as you may not satisfy other tests as we get through them. Okay, so that's test number 1. So the second test is what we call the principal activity test. So essentially, under the principal activity test, the employer entities needs to have its principal activities being the supply, where it needs to supply other members of the group with services. So the employment entity needs to supply other members of the group with services, which they call employee labour services, and they need to consist of the performance of work by individuals the employer entity employs. So that's the key test. You need to supply your employees to the other entities as a service. So it talks about it being a principal activity. So what's a principal activity? It's effectively your dominant activity that the employment entity does. So it's very typical for an employment entity to do many things. It might hire contractors. It might accumulate expenses such as accounting fees and other things that it recharges other group members. It may rent out the building, may rent out equipment, may have a number of things that it does for other entities in the group. When you look at all those combined, its principal activity must be the supply of individuals. So there must be the supply of the services consisting of the performance of work by individuals that the employer employs. So again, if you've got contractors, you need to make sure that they are split out so you can appropriately test whether you are predominantly providing that. So if you're only providing two services, it needs to be at least 51% of what you provide to be the dominant activity. So when do you test the principal activity is one question there. It's silent as to when to test that. And if you're effectively looking at this test, you may have shut down operations with respect to the underlying entities. And so you're providing no services at the moment to them. So the question might be, would it be appropriate to test that now? We would think that you should hopefully be able to look at historically whether your principal activities have been the provision of these services in order to test whether you meet this rule. Okay, so the third test is the external supply test. So in the external supply test, what it requires you to do is look at group members, and they effectively need to themselves pass a principal activity test. Really what this test is trying to do is identify those other members in the group that otherwise are going to be looked at, and it's trying to see whether they are servicing external parties and making external sales. So that's really what it's trying to do. It's trying to link up to those entities that the employment entity provides service to, and it's looking at those ones that make predominantly external sales. So the way it does that, it firstly, the provision tries to identify what we call a test member, which is an entity in the group that receives employee labour services from the employer entity. Once you've done that, it secondly wants to look at that entity, and it wants to make sure that that entity has a principal activity of making supplies to entities other than group members. So again, it is supplying external parties. Now, we don't believe that this test requires you to test each group member and that each group member needs to satisfy this test. So that's our current thinking on this provision. Yet to be clarified by HO, but we'll go through our reasoning here. Firstly, the test says that you only need to identify those members that receive the supply of services. So not every entity will receive a supply of services from the employment entity. So for example, you might have a holding entity in the group, and it might be questionable as to whether it's receiving ancillary bookkeeping services and other services from the employment entity. Now, it does talk about supply services, so those things may be a supply even though you're not charging it. So you'd have to work out whether each entity is receiving services from that employment entity as a first step to see whether they're a test member. But even if they are a test member, then you need to work out whether you would group that entity by looking at whether it has a principal activity of making supplies to external parties. And again, principal activity is a main activity, so you would probably look at its supplies and see that it mainly supplies to external parties rather than internal parties. So roughly 51% of its revenue is to external parties. Now, if that entity only charges internal members, so if it's only doing internal charges to other group members, then that test may not be satisfied. And we believe, therefore, that it will not be a test member in that scenario. Now, that's our current thinking because we believe a test member has to meet those two conditions that are on the screen there. Now, the HO may take a different view and may require that each member has to satisfy that test, or that you have to satisfy it collectively for all test members. And we think the wording uses one or more entities, one or more members satisfying this test for the reason of basically identifying those entities that do satisfy it. The examples in the explanatory statement don't provide much guidance around this area. It does have a group where, for example, they don't test the head company in the group. So we believe that our interpretation seems reasonable on the wording, but it is one critical point we are looking for clarification from the ATO. Do highlight here that the interesting part here is that a test member, so the members that you're testing, may not need to carry on business itself, but they do need to carry on enterprise later on when we go through the turnover test. So that it doesn't look at whether underlying entity otherwise satisfies JobKeeper or satisfies the client turnover or satisfies other provisions in JobKeeper. It just looks at whether those entities receiving the employee labour services are also predominantly servicing third parties. So a simple example to demonstrate. So we've got a consolidated group, just say, with Headco, Employment Co, BizCo 1 and BizCo 2. And BizCo 1 wholly makes sales to external parties, $8 million. And BizCo 2 makes internal sales to BizCo 1. Just say it's $2 million. It could be a warehousing entity, it could be something else. And it also makes external sales of 1 million. So when we look at this, we would look at step one, who is a test member? So who does EMCO provide services to? It could have provided to Headco, BizCo 1 and BizCo 2. So just say they all could be potential test members. Then we look at what are their principal activity and whether they're making supplies to third parties. So assume Headco makes no supplies to anyone outside of the group, but BizCo has 100% of its supplies outside the group, whereas BizCo 2 only has 33% of its supplies. So under that definition, it would seem that the test member would be BizCo 1 and may potentially exclude BizCo 2. Again, we're seeking clarification on the application of this rule, but at the moment we believe that that's potentially how you should be applying this test, to only include BizCo 2 as a test member. So just a couple of quick questions. So when do you test the principal activities of the test member? Again, it's very similar to what we said before. It may be difficult to test the principal activities of a test member right now because it may have no activities, it may be doing nothing, it may have no sales. So we believe it's probably relevant to look at your historical data to work out whether you would principally be providing supplies to third parties. The fourth test is what we call the merely incidental test. And under this fourth test, so you look at the turnover test period, and in this fourth test, the employer entity must not supply employer labour service to entities that are not members of the group. And then it allows you to disregard supplies that are merely incidental to the principal activity of the employer entity. So essentially what it's saying is the employment entity, you can't provide your services to any member outside the group, but we'll have an exception for something that's merely incidental to your principal activities. Now, we believe that this test was brought in to provide a de minimis. For example, we raised in submissions when we did consult on these provisions, we raised in submissions what happens if you provided 2% to a member that was, just say, an investment entity in the group that wasn't grouped for GST purposes. Would that 2% disqualify you from this rule? So this was the rule that was brought in. And we believe it's unfortunate drafting in terms of the words they chose to bring in this, what we would call de minimis rule, because the ATO have taken a view on almost the identical words in a tax determinations TD 2019-13, where effectively they take a view that merely incidental to principal activities means it's just a supporting role to the principal activities. So you would look at your principal activities, look at whether it supports those activities, and therefore it can be merely incidental to those. So providing third-party sales may not be supporting the supply of internal sales, and under the view that's contained in TD 2019-13, potentially could mean that you don't get to apply a de minimis rule if you're supplying third parties. Now, we don't believe that was intended. The explanatory statement makes it very clear as to what the rule was trying to do. In one occasion, it says that the employer entity must provide no more than incidental services to third parties. In another occasion, it says the employer entity undertakes activities wholly as part of the group other than making supplies outside the group that are only incidental to the principal activity of the group. So these two passages in the explanatory statement clearly, in our view, would state that they were intending to have a de minimis rule, but they just, I think, have unfortunate words that they've used in this provision. HO will obviously have to provide guidance on this. Hopefully, if they do come back with a de minimis rule, it may be acceptable to have 2% or 3% of your turnover, of the employer entity's charges going to third parties potentially. But again, we have to wait and see what the HO say on this. So just to demonstrate a very basic example, in this example, you'll see there that it's got a employment co on the left side has a $50,000 charge going to the investment entity that's not a part of the group. And effectively, there'd be a question here of whether that would be merely incidental, whether the HO would accept that in this case. We think that should be a reasonable interpretation, but we'll have to see what the HO says. So finally, the fifth test is an integrity rule that is in the provisions, a very strange provision in itself with not a lot of guidance. Essentially, it says the commissioner has the ability to determine in writing that the modified test does not apply to an entity when considering the purpose of the JobKeeper scheme. And on that, it says generally the commissioner can look to make a determination where he believes the test is unsuitable to the relevant entity, or if he believes there is a risk to the integrity of the administration of the JobKeeper scheme, e.g. due to poor compliance history of the relevant entity. Now, we think that this rule was brought in because the provisions for the employment entity exception had to be drafted very, very quickly. Treasury probably didn't have much visibility into how broad the scope would be and could have got concerned in terms of the types of arrangements that could be put in place where an employment entity could be interposed now or could be put in place from now that may otherwise get access to these provisions. So they obviously had a risk there that it may be unsuitable, or they may have had a risk around the compliance history of the relevant party putting together those arrangements. So they believed an additional integrity rule was needed. Unfortunately, this allows the commissioner to select a party and in writing tell them that they do not believe it's suitable. And it doesn't talk about the timing of this, but we believe they could retrospectively potentially apply this provision. So you may go down 3 months of JobKeeper claims under the employment provision, and they could potentially in writing tell you that they believe it's unsuitable. In such a case, you can challenge the ATO's view. So the ATO's view can be challenged under Section 13 of the Act. It is one item that the AAT can look at and can review a decision of the commissioner. So he doesn't have complete power in terms of overturning the JobKeeper arrangement, but it is quite a high level of uncertainty if you are looking at applying these employment provisions. So to the extent that you are worried about the commissioner applying this provision or have concerns that he could potentially apply it in certain circumstances, then you may need to approach the commissioner just to make sure that he isn't applying it. Now, look, one example that we could think of where the commissioner could think about applying this is you might have a group where where we have two entities. One entity supplies 2% of the group turnover to third parties, and the other entity, which has 98% of the revenue, is just an investment entity. And the employment entity may service 98% of that investment entity. And you might get JobKeeper for all of the employees, basically because that business entity, which is only 2%, has been shut down under COVID. So the commissioner may turn around and say, we don't think that's appropriate, maybe unsuitable, looking at the scheme of things, may then decide in writing not to let you apply the provision. So if you are getting the JobKeeper payments through this provision and you think that potentially you may not be qualified to get it due to your circumstances, you should be looking at this commissioner's power very closely. So I just want to run through a case study because we've gone through 5 of the tests. And I just want to go back and just reiterate the case study, a case study that demonstrates those 5 tests and how, again, you may go through a set of calculations. And I'm just going to use exactly the same facts that I just done on the prior example. So if you recall, we had a consolidated group. It had head co, it had who owned the shares in employment co, owned the shares in BizCo 1 and BizCo 2. Remember that BizCo 1 had 8 million of sales completely to external parties. and BizCo 2 had 2 million internal and 1 million external headco. In this case, I've got headco with some rental income. I'll show you that on the table in a moment. Also recall that there were some charges made to the relevant entities. Employment Code did charge both BizCo 1 and BizCo 2. Didn't charge anything to headco, but might have provided services to them, has charged $50,000 to the external party. For the purpose of this, we're going to say that it otherwise meets the merely incidental rule, so it isn't precluded from applying test 4. So in this example, Employee Co is merely providing all those services to other members of the group. So assuming we get through our conditions with respect to that group, these two tables are looking at the relevant projected turnover at the top table and the current turnover in the bottom table for each of those entities. And recall, what you need to do is take away the turnover of the employment code and replace it with the test member turnovers. And when looking at test member turnovers, you would look at their taxable supplies and then you look at their tax-free supplies. The table basically is showing you a total there. The total for, I'm putting down a June 2020 quarter for each of those entities, the top table, and the total for them in the corresponding June 2019 quarter for each of those entities as well. So we've got the data. How does this all apply in this case? So the first step would have been to look at which of the entities are a test member in order to work out whose turnover we can include. So obviously the employment company is not a test member. You do not include their GST turnover. We look at headco, and we didn't charge headco anything, but the provision doesn't talk about charging an entity with employment services. It talks about providing the supply of employer services. So a supply under the GST Act is a defined term, and so even though you might not be charging headco anything for the period, you may still be providing it or supplying it employee services. So there's a question there as to whether you would include headco. BizCo, we obviously did provide employee services to it as an entity, and it predominantly or principally was providing third-party sales, so that would be a test member. So we can include its projected GST turnover and compare that to the current GST turnover. That was the only entity, however, it only has a 27.2% decline, so it wouldn't get through the rules on its own. Now, BizCo 2, that entity in itself, as you recall, was predominantly supplying the internal entities. So there is still, again, a question as to whether it meets the test member turnover, the test member provision. Now, test member was ambiguously defined as anyone who received employee services, so it could meet the condition if it just received employee services. But there's a secondary test which talks about principally providing service to third parties, and it's questionable whether it needs to satisfy that to come into this test. Now, if I did a total test and included headco and BizCo 2 in there, you can see I've got a decline of 34.7%. But if I only looked at BizCo 1, I'd only have 27.2. Now, our initial view on this test is it only includes those test members that meet the principal test, the principal activity of supplying third parties, and we believe that it should only be potentially including BizCo 1. Now, we have written to the ATO and we have written to Treasury to clarify this type of example to make absolute certain that what is intended is only to include BizCo 1, because the drafting of the provision is very unclear at the moment. You can see in this example how you get a very different result depending on which members you include as a part of that group, which turnovers you can otherwise include. So it is quite important to understand who would be in the group. Now, before I go through the ATO compliance document which has come out, I've just got to quickly reiterate a few final points with respect to the Treasury amendment. So the first is, which isn't on the slide, is that it's a very narrow provision. Okay, it was drafted intentionally very narrowly. It only covers groups, and a lot of employment entities will be out of the provisions because they aren't a part of a group. So it is intentionally being drafted narrowly as in scope, and so it doesn't apply to a lot of groups. So first critical question is you've got to work out whether you otherwise are in the provisions. The second point, which I note there, is that there's a lot of outstanding issues. I've gone through a number of uncertain items through this presentation. We are trying to talk to the ATO in terms of getting responses. We don't think that should hold up anyone doing calculations, because we believe you can cater for the alternative scenarios and to work out whether one interpretation will give you a different result. Hopefully in the next few days we will get an answer with respect to those items, so it should not hold up people doing calculations or doing their testing. But there are a number of outstanding items that need to be resolved. The second point is alternative tests can be applied to each test member, so you can potentially have up to 7 different alternative tests for calculating your GST turnover. So if you incorporate those and do look at all those alternatives for each of those test members, you can get to some very complex calculations if you have a very large group. So just highlight there that your calculations could be quite complex and quite extensive. And for those that are looking to try and make the 8th of May cutoff date, which is this Friday, it is quite a lot to do to get to this Friday and get those through, get those reviewed, and make sure you're comfortable around those calculations. So if you are in this situation, you're looking to apply the employment test, I do highlight that that you do probably need to be working on this as we speak, and need to get on top of that and need to get your advisors involved in making sure that you're doing everything correctly, as the rules are quite complex. If you are getting stuck on this, I would advise also potentially talking to the ATO, seeing whether you can get any extensions, seeing whether you can get any support from the ATO as well. Okay, so that is the Treasury modified test for employment entities. The ATO also on Saturday released a compliance guide covering the integrity rule section 19. And interestingly, that covered a number of examples covering employment entities. That is very relevant to our discussion, because what it is intended to do is hopefully provide an appropriate solution to employment entities that can't fall into the Treasury rules. So the ATO have issued a PCG, and the PCG is 2020/4 is the number of that. Now, what the PCG or Practical Compliance Guide is doing is it's providing some examples about when the ATO would seek to apply Section 19. And Section 19 is the integrity rule where if you do something for a sole or dominant purpose of effectively being entitled to JobKeeper or getting a larger JobKeeper payment, then essentially the Commissioner can determine that you were never entitled to that payment. So the questions come up, for example, if you're an employment entity, a service entity, and you reduce your fee, would that be something done that otherwise would trigger Section 19? So it has been a question that has been provided to the ATO since day one. And effectively, where it was good that the ATO has provided some guidance around this provision over the weekend. Again, I'll just highlight that the integrity measure is quite significant. If the ATO applies the integrity measure, it creates an overpayment debt. So you are required to repay all of JobKeeper plus GIC. And if you've made a false or misleading statement or there's fraud, there can be joint and several liability. So there can be other parties that are brought into the liability as well under those provisions. So just be very mindful of that. And again, I am just going to highlight there's a lot of other penalties outside of the Tax Act as well that you could be up for, including fines and imprisonment. So the integrity rules are ones that are, the integrity rule that's contained in there is quite a scary provision and is one we were looking for guidance from the ATO for a period of time. Now, inside the PCG, the ATO has given a number of examples. I believe there's 5 examples that cover employment-related entities. I'm only going to cover 2 and then quickly just touch on the other ones. The first example, which is example 4 in the ATO's compliance guide, covered a scenario where you had the service co, E, who had all the employees, and it provided services at a cost plus markup, I think it's 1.6% in the ATO's example, to an operating company, and the operating company had a massive decline in turnover. So its turnover has gone from 1 million down to 200,000. So it's basically dropped by 80%. So what's happening in this example is the service co understands that the operating co won't be able to pay the fee, and charging the fee would probably result in the operating company going into losses, may not be able to pay that, probably may have to forgive the debt later on, may cause solvency issues, other things if there's a debt on hand. So it may commercially decide to reduce the fee to 150,000 in this example. So the question would be, would that invoke Section 19? Have you done something to get access to the JobKeeper provisions in this example? So in example 4, the ATO have come out and said, because this scheme is entered into in response to the significant impact the external operating environment has had on the business of operating company E, where the employees of service company E serve, and those external factors are beyond the group's control, there is a low risk that the Commissioner would apply his compliance resources to consider the application of Section 19. So this is quite a good example, and it's been good the ATO have come out and provided some guidance around this. Now, they're not saying that Section 19 doesn't apply. They're only saying that they wouldn't apply compliance resources with respect to this example. So it is quite critical that whatever you're doing, it is commercial, and that you still be aware that the ATO is not signing off on this example. They're just saying that they won't apply their compliance resources in examining this type of scenario. But it is at least a good message to provide some comfort to employment entities that are faced in this situation where they don't otherwise get access to the Treasury's grouping rule. The second, I think, most relevant example is example 5. It's the same example as the prior one, but what has happened in this scenario is since COVID has hit, the employment entity has had to reduce staff hours or has had to let staff go or has placed staff on stood down a number of staff. So in that case, the employment natural costs of service co have reduced, and because the cost plus markup to the employment co, the service fee has otherwise dropped. In this example, just say the cost of employment's gone to 500K, so the fee will drop down to 508K. The fee dropping would be sufficient, just say, to get within the 30% rule when comparing to the prior year. The service co in this example would automatically, therefore, have resulted in a decline in turnover. The question is, by letting people go or by reducing hours, would that result in Section 19 applying? The ATO has the same conclusion in this example. They say because of direct response to external factors, effectively COVID-19, the ATO do say it has a low risk of applying compliance resources to this example. Again, doesn't say Section 19 doesn't apply, just says a very low risk with respect to this example. There's, as I mentioned, 5 examples. We just went through the first 2. Please note that there's example 6, again, another service entity. It's saying there that you may not even reduce the fee, but because you know that you may not collect that fee in the future and therefore may need to produce credit notes in the future, when estimating the GST turnover, you can estimate that you'll have a reduced GST turnover for the period. Note that if you write that off as a bad debt, you cannot reduce the GST turnover because technically it doesn't reduce GST turnover. So there is another way of getting there even without changing the fees if you expect that to potentially result in credits being provided in the future due to the operating condition of the underlying entity. There's also 2 additional examples there with management fees from the parent company. So the same is not limited to just service co's. A holding company could get the same scenario if it is the employer. And example 7 is almost the same as the example 4. I think it says example 1 there, but let's say example 4. They do have another example, example 8, where they say, look, the parent company just alters the fee, and so it gets in the 30% decline test. And in that case, they say, because there's no COVID-related impacts or external factors that result in the reduction of fee, it has a high risk of ATO compliance activity, and that is something the ATO would look at in this case. There are other examples within this practice compliance guide that you should be very well aware of, especially around employment entities. Example 1 and 2 deal with scenarios where you delay invoicing or you've brought forward invoicing, and that impacts on your GST turnover, and you get in the rules by either doing one of those 2 schemes as well. Again, the ATO say that has a high risk of compliance resources being applied to those circumstances. So just be very aware that activities that result in a change of the way you're invoicing, and if the HO conclude that may be deliberate, you have a high risk of HO compliance around those activities. So just some final thoughts on the HO's PCG. Again, I'll just reiterate the PCG is not a sign-off by the HO on these examples. It's just a risk of HO compliance. If you have concerns, you obviously could talk to an HO officer, take them through your scenario, point out that you're in line with the PCG. Hopefully that can bring forward any discussion so that you can get comfort around your scenario and where the HO would take action with respect to your scenario. Provided that you're being completely commercial and you're looking at the way it's impacted the group, I believe the HO will be reasonable in those circumstances. They've been very reasonable where entities have been impacted by COVID-19. Remember, as I pointed out earlier, that the employment entity does need to satisfy the basic conditions for JobKeeper. So it does need to, again, satisfy carrying on a business on 1 March 2020 in Australia. So if you're an employment entity that's just charged costs historically, doesn't have a legal agreement in place, those ones are the ones that could be at risk of the HO in the future, saying it doesn't carry on a business and it may not be one that can get access to the JobKeeper provisions. You would also have to look at in your arrangement, if you are looking at reducing fees, can you legally reduce fees? Some of them do have a cost plus mechanism and may not have ability to reduce fees. If you can't reduce the fees such as that, you may need to enter into a side agreement that agrees to reduce the fees. So you just need to look at your commercial arrangements and whether, for example, they can be capable of an adjustment. The final thing, and a very important thing, is if the service entity reduces its fee, you would need to think about whether the losses it makes, because it's not charging now for its employment costs, would otherwise be deductible. And there are some cases, a case called Urey and a case called Fletcher, that says if you're providing effectively support to your related parties and your costs are being incurred to do that, they may not be deductible. Now, the two things to think about here is that even though you may not be getting a service fee, these entities may receive the subsidy from the ATO, so it may receive other accessible payments, which may offset otherwise those deductions. So the extent of the loss may not be as significant once you get JobKeeper payments. And secondly, if these are commercial decisions being made so that you can continue to trade and continue to make charges and profits into the future, there may be arguments there that you are able to still point to the earning of accessible income in the future and the carrying on of a business. So there would be arguments again around that, but I would suggest if you are in that scenario, you should seek to ensure that you get some advice, have a look at your scenario to ensure that you're not going to jeopardize tax deductions in those cases where you're no longer charging a fee, but still incurring the costs. So that brings me to the end of the presentation. I'm just going to recap again, just to say that these provisions are very new. They only came out over the weekend. And so these are our initial thoughts, having gone through those provisions and trying to articulate exactly how they may be applied to your circumstances. If you do get into Treasury rules, there are quite a lot of calculations and quite a lot of complexity that you do need to get to. So you should be working on those as we speak if you're looking to do an 8th of May payment for the employees that have been under $1,500 and looking to register. Again, if you are looking at using the ATO's compliance saving measures, you do need to look at it in particular in terms of when you're doing adjustments or which are the provisions you're applying, whether it impacts on the projected or projected turnover for a test period. If you're making an adjustment now, does it affect the June quarter? How does that impact on which test period you're claiming JobKeeper for? Look at all your qualification requirements and also think about whether you need to approach the ATO to ensure that you're comfortable around Section 19, given the ATO's comments in the PCG. So there's quite a little bit of things that you probably need to go through. That brings us to the end of our presentation. Again, I thank you for attending. I hope you got a lot out of this session. Please do look out for any new information that is coming out, bulletins that we send out, ATO new guidance that may change anything that we've discussed. Wish you all the best in terms of your review of these provisions, and thank you very much for attending.